So now that we know what an income statement is, we know what a balance sheet is, let's talk about the differences. And it's important to know the difference between the two because this can often be pretty confusing for business owners. When we think about an income statement or a balance sheet, we need to think about and know where transactions hit. So when you spend money, when money exits your account, it does not necessarily always go to your income statement and reduce the profit of your business. And I'm going to go through a few examples to go through that. Let's imagine you have an asset purchase. You purchase of a piece of equipment for $10,000. You would not deduct or expense that on the income statement right away. Instead, you would take that $10,000 in cash and you would add it to your balance sheet as an asset. So that equipment would go onto your balance sheet as an asset. And then you would expense that piece of equipment over time via depreciation. And when you expense it via depreciation, this is when you get the actual expense for it where it'll show up on the income statement. Let's think about a loan. If you have a loan, you would only be able to deduct, if you make a loan payment, you're only able to deduct your interest expense portion of that. Principal payments are not deductible. They simply lower your loan payable balance on your income statement. So let's say you have a loan payable of $10,000 and you make a payment of $1,000 and $100 of that's in interest. You're going to get an expensive interest expense for $100, but that other $900 on that payment that you made is simply going to reduce your loan balance. It's not going to be an expense. And the reason that is because on the same note, when you received that loan money coming in, it wasn't considered income. Instead, it increased your loan payable amount on your books. So you receive money in via a loan. That's not income to you. That's just creating a loan that you have to pay off. But in the same note, when you pay that note or when you pay that loan off, that's not an expense. Just the interest piece is. Next, let's think about owner's contribution or an owner's draw. When you contribute personal money into the business, that is not included as income to the business. Instead, it's recorded as an owner's draw on the balance sheet or an owner's contribution on the balance sheet. In the same note, when you withdraw money as an owner's draw or distribution from the business, that is not an expense to the business. It's simply listed as an owner's draw on the balance sheet. In any kind of normal income and operating expenses, these are the items that are going to hit the income statement right away and factor into your profit or loss, which is what you, in the end, pay taxes on.